Good morning, Tom.
Good morning. My name is Tom Leahy. I'm your internal partner at BlackRock. Thank you for having me. It's a pleasure to be here. Nice to put some faces on some of the personalities I've gotten to know over the phone. And if you don't mind, today I'd like to only come with one idea. BlackRock's best idea. It's my first time in the office. I only want to bring you the best. And I like to keep it on the shorter side. I want to spend more time listening and learning and less time talking, quite frankly. In particular, I want to talk about the core of your clients' portfolios and the foundation of your growing business. When you think about a core, you want something consistent, something with a track record, and something with intuitive fundamentals that you can have confidence in while talking to your clients about and have confidence in moving forward. BlackRock's Global Allocation Fund, since 1989, has delivered 10.5% annualized return with a third less the volatility of the S&P 500. And today, I'm here to talk about why or how it's done that and why we feel it will continue to do that. And in particular, there are three points that are intuitive to me and I've noticed are intuitive to some of our best advisors. The first is a flexible, holistic asset allocation strategy. The second is sweat equity, bottom-up security analysis. And the last is that risk management, that downside protection that so many of you call in about and that I find really resonates. But before we go in, just so we're on the same page, I hear what you're saying. You're worried about the delevering that our country's going through. You're worried about the slowdown in growth that comes from the delevering. Fed is blowing up its balance sheet, and we're worried about inflation moving forward. And perhaps the most relevant is going to be the political instability and how our government officials can just not get it together. So global allocation. When thinking about holistic asset allocation, I'm thinking about an unconstrained portfolio that does not have a bench and hasn't had a bench since its inception in '89. So what does that mean? A lot of you are familiar with the Yale Endowment Fund. One of the premises that Dave Swenson, the manager of the Yale Endowment Fund, talks about is how 90% of a given portfolio's volatility is a function of broad asset class selection. Cash versus fixed income versus equities. And generally, a lot of people who fall in line with this philosophy tend to be passive investors. They're saying to me, Tom, this is an active fund in the true sense. So how do we bring these together? Well, by not having a benchmark, the fund can take advantage of good valuations and asset class selection throughout time that provides returns that if you were tied down by a benchmark, you just couldn't have. So let me give you an example. On the eve of the tech bubble in December of 1999, the fund reads 55% equities, 24% fixed, and 11% cash. Over the next 2 years, the A share is up a modest 2%. The S&P down 35%. You need to be able to have the fixed income and the cash, the ability to be fearful when others are being greedy. At the end of 2001, the fund reached 66% equities. They dialed up 11% in 2 years. Why? Because as value investors, you need to be greedy when others are fearful. But not just in security selection, in asset allocation. And that is part of the reason this fund has been so successful over the last 2 decades. Second, sweat equity. What do I mean by that? I mean that there's 40-plus people every morning that put their pants on and go to work working on one strategy for one fund. Global allocation. 40-plus members. It means there's been a portfolio manager, Dennis Statman, who has done the fund every day since inception. He was there at the inception. He's there today. That means experience. That means people who have vested interest in this fund doing well. And for those of you like myself who are a little more value-oriented, this means the team that can handle the bottom-up security analysis that you need to outperform. looking at financial statements, meeting management, and the valuation of securities. Third, and this is perhaps one of the most key selling points in the past, and one of the reasons our advisors keep calling us about this fund: downside protection and risk management. A lot of times I'm having conversations and I get sort of the '08 test. Well, how did it do in '08? Well, the fund was down 19% in 2008. The broader equity market was down 35%. We had the largest global credit crisis. It took us 20 months to get back to break even. 20 months. That's less than 2 years. But the question is how? How can I rely on the downside protection moving forward? I heard about the asset allocation. I see you can move into fixed income. You know, I hear that you're value oriented. But this goes right to the leadership of the fund. On a recent roadshow, Dennis Statman said something that really resonated with me. He said, if I wasn't so experienced, I would be more aggressive. Not only does that bring us back to the experience of the fund, but it means that, you know, it goes to the fundamentals of what BlackRock is built on, and that's that risk management. Even when we have conviction in an idea, we're always hedging ourselves. We're always thinking about what is the probability that we're wrong and how will we be able to cushion. If you'll notice, I mentioned that we dialed up to 66%. We're not at 85%, we're not at 90%, we're at 66%. A lot of our competitors are just coming into this space now, and they've done well over the last few years because they've dialed up their equities to such high amounts. So I mentioned today 3 particular things: holistic asset allocation, bottom-up sweat equity security analysis, and risk management. But I want to answer the question, Tom, but how can I use this to grow my business? And for that, I want to break it into 2 pieces. One is for your clients who are more compelled by the ANC shares. This is a great story, something you can tell. It's been around a while, has the performance numbers, has the story of the team getting together, the same portfolio manager. And I feel that this can be a great core solution for those particular investors. And second, for those of you who are in the more Repus PM model, this can serve as the anchor that you trade around, or in times when you have lower conviction ideas, you can use this fund to express BlackRock's best ideas and then dial it down as you have higher conviction in the markets. So before I sit down with each of you and figure out how this fund can continue to do well in your clients' portfolios, particularly at the core, I'd like to take a few questions. Ken Bradshaw.
You spent a lot of time talking about sweat equity and individuals putting their pants on every day, doing a lot of the bottom-up work, and you also spent some time talking about Dennis Statman, how he's been on the fund since day one. With all the portfolio manager changes at BlackRock this year, what happens the day that Statman leaves? I mean, I can't see a research analyst taking control of an $80 billion fund.
Well, I think the first thing I can say to that is that is a concern that we get quite frequently. And I would like to confirm that when we do sell on a manager, that's a good question. A lot of the members on the team have been there for longer times than you'd expect someone would at one given fund. A great example is the second portfolio manager is going to be Dan Chamby. He's been there 19 years. He's worked every day with Dennis. I mean, 19 years, that's 2 decades, right? He's worked every day with Dennis. And a lot of the team members, once they go into global allocation and they get in there, they never leave. So the culture, the value, the risk management, these are things that are organic, that are intuitive to the fund. And I think even when Dennis leaves, we should still have conviction that someone will step up and the team will still function successfully.
You guys, I mean, I'm familiar with this fund. You guys have definitely struggled over the last 2 years, call it. I use PIMCO All Asset Authority. I'm getting 6.7% yield. The performance of that fund is much better than yours. As a matter of fact, I'm blowing out a global allocation for all my money. All assets. Why should I still consider your fund versus that?
The important thing to remember about global allocation is that it's a value-oriented fund. And I want to harp back to someone that we can all relate to when it comes to value. That's Warren Buffett. When they asked Warren Buffett, are you worried about Berkshire? He says, I've seen a 50% drop in Berkshire from top to bottom, and I don't even think about it, right? And I think it's happened 3 or 4 times in his career, 50% top to bottom. He doesn't worry about it because value investing takes time. And to really beat the markets over time, if we're thinking from year to year, then it's not the strategy for you. If you're thinking about a core holding, you're thinking about having your client's best money grow and appreciate over 5, 6, 10-year time periods, you need a value-oriented fund, and that can take time. So just to reiterate, since inception, the fund has annualized 10.5% returns. That's not all. That's not year over year. That takes time. Some years it's up 20. Some years it's only up 5. That's the nature of value investing. A law.
Yeah, Tom. So I'm an ex-Merrill advisor, and I'm familiar with the fund. And my biggest concern is the size, because I would argue to you that a lot of the returns and alpha you've generated over that time period, over the last 15 years, come from small cap investing. Mm-hmm. So how can you invest, given the size of the fund today? Mm-hmm. How are you going to keep delivering 10.5 a year?
Mm-hmm. Well, I think the returns come from the combination of both the security selection, as we mentioned in the second point, but also the asset allocation. So when you're looking at a fund that can invest anywhere, you're not moving the market much when you do invest. And if you're worried about opportunities, when you have 40-plus analysts, you can handle something of the size and scope that global allocation handles. So to answer your question, because it can go anywhere, it can look at opportunities across the world and across asset classes. And I can give you examples if you like. We can sit down and talk about times when it has gone into a particular asset class and not just a particular company, which I think may be part of your concern.
What is the ticker symbol for the Asian?
The ticker symbol is MDLOX.
Thanks for coming in, Tom.
Last questions.
You mentioned a couple times early on that the fund really had no benchmark, and then you also kind of pitched it and talked to it as a core holding, which it definitely seems to be. I guess I'm just a little concerned that I could look up one day and the bulk of my clients' portfolios could be in 20% equity, 80% fixed income. I mean, is it truly unconstrained? I mean, just because I want to know what I'm owning, I kind of want to have a feel for what my clients have if it's going to be a core holding.
Well, the internal benchmark is going to be something like a 60% equity and a 40% fixed income, and that can be a good way to think about the fund. But as a core holding, we do believe that you do need the flexibility to be able to say, even though our internal benchmark is this sort of intuitive 60-40, that you have to be able to break that. Like as I mentioned in end of 2001, we thought up to 66. But historically, the fund has never been 80% fixed income or anything like that. It has been within a range of, I would say, 10%. So between 70 and 50 for the equity, and similar for the 40 fixed income. It's never really broken that that range much. So I could definitely sit down with you and we could pull apart the portfolio a little bit more. But you can be confident that our team is not going to put that much risk on the table. And in respect to your particular question, when it comes to core fixed income, we believe that the after-tax, after-inflation returns of fixed income are not that attractive for the long term. So I don't think you'd see that.